Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Hello, I'm Eli, Office Research Lead at Colliers, and welcome to Colliers Talks, where we talk shop on all things commercial real estate and real estate adjacent as it relates to shifting fundamentals impacting core assets across Canada and sometimes beyond. Today, I'm joined by three very special guests who I think are top field experts in the office sector in particular. And in fact, two of them are our very own experts and friends of mine here at Colliers. We'll start off with Jennica. Maybe you can let our audience know who you are, a little bit about your tenure and what you specialize in, and then we'll go ahead and pass it on to Thomas, and I'll have you kind of introduce yourself in the same way. Jennica, take it away.
Absolutely. Thanks, Eli. And hi to everyone who may be listening. My name's Jennica Palecek. I'm an associate vice president in our office sales and leasing division. I focus mostly on the tenant rep side of the business, so helping startups, growing enterprises, and global firms on their real estate. And I'm based out of Vancouver, Canada.
Amazing. Jennica, very excited to have you with us. And before I hand it over to Thomas, I'd like to say congratulations on making VC Business's 2026 30 under 30 list. I gotta say, I was floored seeing you named among some of British Columbia's top rising entrepreneurs and innovators. So big congratulations.
Thank you. And it's big thanks to all you guys who support us and make us look so great. So thank you for all your help.
Awesome. Up next, we have Thomas Coutu. Why don't you go ahead and take it away, Thomas?
Thanks, Eli, and congrats again, Jennica, on that great achievement on 30 under 30. That's really remarkable. So I'm also an associate vice president coming from the Montreal office. Our team specializes specifically on office leasing transactions. We have part of our team members that specializes in landlord representation. Myself and other members do tenant representation with all type of firms running in Montreal.
Amazing. Thanks, Thomas. I've known you for nearly 6 years now, and you're truly one of the brightest agents I've seen out there on the field. And, to you as well, congratulations. Just recently, you made Associate VP, and which in my opinion is well-deserved. So big congrats to you on that as well. Yeah.
Thank you very much. Although I look quite young, I still hold about 10 years of experience in the commercial real estate industry.
Yeah, well, hopefully you'll make the 30 under 30 list like Jennica at some point. So hopefully that'll work out. Fingers
That's the
crossed.
goal.
Yeah. And finally, we have with us, and I'm very excited to introduce this person here, along with Jennica and Thomas, we have Scott Gordon, Director of Asset Strategy at Manulife. Scott, it is such a pleasure to have you with us. Make yourself comfortable. I'm going to go ahead and read your bio. You don't have to say anything if you don't want to, but you can after. Okay. So Scott
Well,
Gordon,
I didn't get promoted, so I feel like I'm belong in the podcast. But anyway, yeah, go ahead.
Okay, well, you know what? Your tenure and your entire repertoire is just amazing in general. So I'm going to go ahead and read the bio and let our audience know who you are. Scott, you oversee Manulife's real estate investment assets across Canada and multiple asset types, including office, industrial, multifam, and retail. And you're also responsible for enhancing portfolio performance and helping to lead due diligence of new markets as the firm continues to broaden its real estate platform across Canada. You've also been with Manulife since 2020 and started in the industry in 2007. Gosh, I can't imagine how that would have been like right before the global financial crisis. But you know what? We're here now, and I'm sure the market uncertainty is nothing new to you, right?
Correct. Yeah, no. Look, thanks for having me. Definitely excited for the conversation, and yeah, great to meet you.
Glad to have you with us. So we're just going to jump right in here. The shift in Canada's office market and probably in the whole of North America has brought about some unexpected challenges for both owners and occupiers. I know much of the industry has thrown this word around quite a lot, but there's a sort of bifurcation happening, particularly among demand. Late last year, Colliers poked around with this idea of exploring the wedge between these fundamentals, like a vacancy, and seeing how it splits significantly between trophy assets and the rest of the broader office market. Now, for this particular talk, we're assuming that we're going to put trophy assets into its own class as AAA. And when we refer to the rest of the broader office market, we're just going to take a step down and include A, B, and C class spaces. Now, that interplay between those two seemingly distinct categories serves not only as a byproduct of the evolving nature of work, but also a trend that kind of materialized to a wealth of strategic planning, both for tenants who are just kind of adopting a more aggressive approach to return to office, and then landlords getting creative on incentives. First question goes to you, Scott. Can you please characterize your team's current office portfolio in Canada?
Yeah, sure. So our entire Canadian real estate portfolio is about 30 million square feet. About half of that is office, third of that's industrial. We got about 4.5 million square feet of retail and about 3,000 multifamily units. But within our office portfolio, as I mentioned, it's actually about 16 million square feet. It's about 90 assets across the country, all major markets, and it really runs the gamut from trophy down to kind of that kind of B minus product that we've owned over the years.
Yeah, glad to hear. And I'm not sure if you are in particularly invested in one portion of the portfolio over others or where your expertise lies, but are you assuming that your expertise lies specifically in office, or do you touch on any other core assets within the portfolio?
Me personally,
Yeah.
um, yeah, look, I came up, early in my career at Brookfield and was definitely an office guy by trade. But obviously spent a good amount of time in the industrial sector and the retail sector. So I wouldn't say I would say I'm more of a jack of all trades than anything else.
Hmm, great. So we've no doubt reached an inflection point with vacancy stabilizing in some areas and slowly declining in others. But will we ever see a recovery back to pre-COVID levels of occupancy? And what's it going to take to get there? I want to throw this question over to perhaps maybe Thomas first. And then if anyone wants to chime in, Jennica, Scott, please go ahead.
Yeah, absolutely. I mean, look, I've been at Colliers for 6 years, and literally started my career as a broker right before the pandemic. So my experience with regards to like pre-pandemic levels is a little bit limited, but nevertheless, we still have the data to be able to support the hypothesis of how the market's going to be reacting in the future. One thing for sure, and I'm sure Scott can chime in on that, is real estate, compared to almost every other sector, is one of the most cyclical industry ever, right? And real estate as a whole, whether it's office, industrial, retail, or other asset classes, have an essential part of our society, right? So before the COVID pandemic, at least in Montreal, we were looking at a vacancy rate sitting around 9 to 10%, and now we're closer to the 20%, and we topped it up at close to 21%. So we're seeing an inflection point now in the past quarters, and there was a trend towards the pandemic where people were going to be working from home, and companies were taking concrete decisions based on uncertain times, and we're seeing that shift change. I guess it's mostly culture that I would say is the most impacted for office companies, and the reaction to how their operations are being held post-COVID and with everyone working from home. So we're seeing a lot of companies coming back to the office, both banks and governmental tenants, forcing their employees back to the office. We have to also remember that throughout the pandemic, the labor market was holding the bigger end of the stick. So if employees truly wanted to work from home, they had the power to do so. And that's shifting with current economics conditions. So I think, will we ever come back to 10%? I hope so. I think so in the next couple of years. It's going to take some time, obviously, for the market to adjust. But I remain, and our team remains optimistic on the future outlook of the office market.
Yeah, I mean,
Scott,
look,
what do you have to say?
Yeah, no, just to jump in. So obviously, I think last year on a blended basis across the country, I think vacancy was down about 120 basis points year over year. So that's a great start. I think to Thomas's point, there's still a ways to go, but we're seeing a development pipeline slow down. Obviously, I think you're still going to see a couple of assets get taken out of the supply in various cities for conversion. I think as you're seeing a return to RTO, I think all those factors will see us get back to pre-COVID occupancy levels. I would say if you look at our portfolio, it's interesting. We're actually not that far off already where we were pre-COVID. And that's on a blended basis. So that's not just our trophy portfolio. On a blended basis, we're actually not that far off. And I think it's a testament, obviously, to our team across the country in terms of being, very, very competitive in how we go and win deals and really focus on the performance of our portfolio. Yeah, obviously, the trophy segment in our portfolio is leading the way. You look at, buildings like 707 Fifth in Calgary, building that was 50% leased, pre-COVID, as you had a lot of new product hitting the market in Calgary at the time. That building's now fully leased, right? So you see our trophy product leading the way. I would say the same thing, by the way, about 900 de Maisonneuve in Montreal, as Thomas knows as well. But even in our kind of Class B portfolio, we're definitely down from a pre-COVID perspective, but we're not down as much as you think. And so again, I think it's a testament to strategically looking at your portfolio and figuring out how to get that leasing momentum and how to win those deals.
Well said. I want to throw this question over to Jennica, mainly because I'm my knowledge on the West Coast is a little bit limited, especially what's going on with the trophy assets in Vancouver. I kind of want to get your perspective on this. What did you notice about the interplay between trophy offices and other tiers of office assets in Canada last year? And what key themes would you say many are expecting to see in 2026?
Yeah, that's a great question. And so it's interesting hearing about markets in Montreal and Toronto and elsewhere. Vancouver has always been operated a little bit differently. We don't have as big of swings as, for instance, Toronto. And before COVID, AAA downtown core, we had 2% vacancy. It was like industrial. You're putting together a couple options for a client. And you have 5 options, and people think, really, this is all that there is. And you're looking, you're calling everyone. There's nothing coming available. So we needed a little bit more optionality for tenants. And now, since then, in the past 25 years, we've actually hit a 25-year high in terms of vacancy. Downtown core, we're at just over 12.1% across all asset classes. And so we're the highest we've seen in over 2 decades. And so I think some groups, who just aren't familiar with this vacancy have been a little bit startled by it. But when you really zoom out and you compare it to other markets and the recovery, we're still doing pretty well. And we're still a bright light for a lot of the other ownership groups. When you kind of look at just trophy class assets, that's where we've seen the most activity, of course. Like our AAA asset vacancy downtown, it's 8%. If you compare that to the C quality buildings, there's almost a 10% delta there. It's at 17. And so throughout COVID, similar to Thomas's point, everybody has been upgrading their space. We had the highest number of buildings, AAA buildings delivered during COVID. And at the time, everybody, it was the worst timing possible because it was right when nobody was in the office. People were downsizing, people were giving up space. You had sublease space on the market that was sitting, that was getting discounted, that was move-in ready. And so at that point in time, it felt a little painful. And now, once we've seen all the companies have a little bit more certainty and be able to commit to the space, Blake's, Deloitte, all of the big names, they've all taken that AAA space. And most of those buildings are now fully leased. And so you're just seeing people be able to commit to spaces better. And the spaces that they are committing to are those trophy quality buildings. And so we've seen our C class get a little bit left behind in some way. And we've seen that delta completely expand.
It's really interesting to see too, because Vancouver's layout of the AAA market, the trophy assets, are a bit different from most other markets here. It's not just scaled down to the downtown core, I believe. Correct me if I'm wrong, but there are some AAA assets sprinkled around Vancouver, or the midtown, maybe suburban areas. So it's a bit different to see that layout compared to, say, Toronto or Montreal, where it's all concentrated into the core, right?
Yeah, we've actually had a lot of new development, a lot of new AAA buildings developed in the suburbs, especially if you go out Langley, Surrey. Our team over there has never been busier. Just with people working on a hybrid basis and a lot of folks having moved from the downtown core and maybe living in the suburbs now, it just makes it a bit easier from a commute. So that demand's caused a lot of new AAA development there as well.
Right. So Scott, I want to go back to you. In terms of flight to quality, I know this word gets used ad nauseum. is this still playing a major role in how tenants are getting back into the office? Is quality of space, building services, amenitization, are these things still top of mind when searching for ways to bring people back to the office?
Absolutely. I think you do have to bifurcate between trophy and between the other asset classes. Obviously, as you go into the kind of that B and C class, you're obviously focusing more on economics, versus the higher end asset classes. You're just competing with people that are just providing those higher end services. But yeah, look, I mean, I think if you look at, I always thought, Chicago was kind of leading the way with respect to amenitization. And I spent a lot of time in Chicago, and you see what landlords are doing down there. But I think it's definitely coming into Canada. You're seeing what's happening in the 68th floor at Super Plaza. You're seeing it all over the place. And I think when you look at our portfolio, you look at 707 Fifth again in Calgary, where, I mean, that's a brand new building, but we went and spent more money, up in a mezzanine there to create a real tenant lounge that can actually be used. And I think that's the biggest difference when you want to talk about amenitization, which I think we'll probably talk about in a little bit, even more. But this is not a check the box exercise anymore, right? Like there's got to be amenities that people are actually going to use, because at the end of the day, these employers are trying to get their tenants back to the office and want to be in the office. And so these actually have to be amenities that you really want to use. The other example I would use, with respect to leasing, we've got a case study with formerly Manulife Place in Edmonton, which is now National Bank Center. Not in the Ice District, but I would argue probably the best located asset in Edmonton. And we and our 50% percent JV partner have gone, and we're spending about $40 million in that building on a ground plane renovation, but really putting a lot of money into the amenities there. We signed a 225,000 square foot lease with at the time Canada Western Bank, now obviously National Bank. So that asset is almost fully stabilized, and that lease was predicated on the fact that we were going to go put those kinds of improvements into the building, because that's the kind of building they wanted their employees to be at. So I absolutely think the flight to quality is there, and those buildings are winning. Even if it's not trophy, it can still be Class A. And I think if you're offering the right amenities, and by the way, I think that building now has, obviously I'm a little biased, but I think that building has the best gym in the market. I think it's gonna have the best conference center in the market. It's a phenomenal renovation. Our view is, tenants still want to know that they're going to get an elevated service offering. And even if you don't have the best amenities in the market, I think tenants knowing that they are getting best in class service from a platform that knows how to train their employees and knows how to deliver those services globally, and what defines best in class service, that means something. And tenants can see it on a tour, and tenants can hear it from other tenants in the building. So I think all of that stuff is super important.
I think it's also worth noting that, the term flight to quality has been thrown around left and right, but mostly attached to the principle where you have a tenant from a B class asset that's going to an A class, and then a tenant going from an A class asset to a triple A class asset. But we have to remind ourselves too that it's the whole package of a flight to quality. So it can also be from a geographical perspective, right? So if you have a tenant that's occupies a space in the suburban area but wants to bring their employees back to the office, well, the main concern for these employers are commute time, service offering. But the service offering and the amenities don't necessarily have to be absolutely within the building. They can be, in neighboring buildings or in the environment itself. So, I think it's a good segue to also present an example that Colliers did within the Manulife portfolio, where Michelin occupied, quite a good chunk of space in Laval, which is a suburban city around Montreal, and they moved their offices and took 35,000 square feet in one of Manulife's portfolio building in downtown, which doesn't have any amenities other than, interior parking, security. It's well maintained. It's been recently renovated, but in and of itself, there's no amenities. But the fact that they're directly connected to the metro system, and in Montreal, the underground system, allowed the employees to be able to walk. Our winters are harsh, right, compared to Vancouver or even Toronto. So giving the ability to your employees to be able to just walk in the Montreal underground system, which is one of the biggest one in the world, to go to the gym or go to the food halls, etc., gives that same stability and compensation that those AAA class assets are fighting for by amenitizing their building.
Well said. So I'm going to shift gears a little bit here, and just ask, is downsizing still considered a relevant strategy for a lot of tenants, and how so many companies have transitioned or seem to have transitioned away from just exclusively doing flexible work or even just hybrid work altogether? Is it still in play? Is it right sizing now? Are you seeing expansions? Maybe, Jenica, if you could shed some light on that.
Yeah, I was just thinking when you're asking that, it's across the board. And it really depends on sector specific and then also culture. It seems, at least in Vancouver, that there's no one size fits all. When I read about, other markets, New York and San Fran, it kind of seems like they're all going in a similar direction. It's very return to office, lots of expansion, AI is on fire, all the banks returning to office. So those two markets with those sectors being dominated there, I think just have naturally, have kind of gone into that swing. Versus Vancouver, we're not dominated by one sector, oil or gas or tech or finance. We have a bit of a mix. And so because of that, you're seeing so many different styles of return to office. But for all the big tech companies, they're mostly in, 3 or 5 days per week. We're seeing a lot of, legal services, professional service firms have expansions. Tech throughout COVID, not surprising, they were already set up for, work from home or hybrid. And so a lot of them shed a bunch of space throughout that time and then now are starting to expand. In 2021 in Vancouver, we had the highest number of unicorns ever, highest number of companies to ever reach $1 billion valuation. And so all these companies, because the market had always been so previously tight, they were taking real estate not only for today's headcount, but for headcount in 2 years. And actually, many companies took full floors, didn't occupy. And then COVID hit. And, we all know the story with interest rates and venture capital funding drying up. And now we're reducing our headcount. And so that floor never got occupied, gets subleased. And we had a lot of stories like that. And so I think that that's still in the back of people's minds, especially for tech, just because it happened a couple of years ago. So we're seeing that even once people raise that venture capital round and they're planning to hire, maybe instead of having, whatever it would be square footage per person, they're being a little bit more conservative. So we're still seeing expansions. It's just not as drastic as it was before. And then for finance, for legal, for professional service firms, I'd say across the board, we're seeing expansions, which is all really good news. And that's kind of where most of our demand is going. Before tech was about 70%. Now leasing demand, it's mostly professional service firms, education, healthcare, and tech's about 30.
Yeah, I think just to build on that, if I look across our portfolio, and by the way, I think everything Jennica said is kind of consistent with what we're seeing. But I think if you're looking at some of the non-finance industries that are frankly getting impacted by more the geopolitical stuff going on right now, those are the tenants that you're seeing downsize if they're downsizing. But as it relates to just purely kind of COVID related issues, obviously we're seeing across our portfolio, we've got multiple examples of where we've got banks that are expanding back into space that they weren't occupying, frankly, for years. And so that's great news to see. We've got an asset in Ottawa where we've got tenants who are now finally expanding. So I think at the end of the day, anyone where return to office was really the issue, everyone's now kind of made their decision. And obviously that's being led by the federal government now, by the province of Ontario, and everyone's back. People have made their decisions. And so you're seeing some of those larger tenants now saying, okay, we know what the world's going to look like. So we're now going to act like we know what our footprint needs to be. And so now they're in the market, looking for their permanent home. And so, yeah, 100%, we're seeing way more expansions in our portfolio than we are downsizings, but it's not, I wouldn't say it stopped.
Mm. And it's interesting you say that too. I was talking to an advisor once, and I made the analogy that a lot of these companies, when they're imposing these return to office mandates and policies and strategies, it feels like a mother duck with its ducklings trailing behind it. You always get the big reputable tenants going in first saying, we're bringing our employees back in. We're seeing the government doing it. We're seeing the banking sector doing it. And then following suit are competitors. And then it becomes it's not a question of flight to quality at this point. It becomes flight to quality to try to get into those spaces. It's particularly the trophy asset spaces that we're seeing sort of squeeze in terms of supply now in the markets like Montreal and Toronto and Vancouver. So Thomas, when I first spoke to you about this report, you had mentioned that there was an added benefit to seeing that squeeze happen in AAA towers, which is this trickle down impact. We got to find a better word for this, maybe a word that we can coin. I don't know, trademark it. So then, what are the trickle down impacts of strong Class A leasing on the broader office market in Toronto? Like, what does that look like? In not just Toronto, but in Montreal specifically, I want to know. And maybe we can shift gears over to Scott and then try to understand what's happening in Toronto as well. But from the fundamentals I'm seeing, we're starting to see an uptick in activity in AAA across MTV. What's happening there?
I mean, at the end of the day, everything's about supply and demand, right? So right now, if we're looking at Montreal's downtown asset class vacancy rate, the AAA asset class at the beginning of the quarter was sitting at around a 7.5% vacancy rate, while the rest of downtown and A class assets specifically were at about 18.3%. Place Ville-Marie is a great example of it. Place Ville-Marie is about 1.8 million square feet of inventory of office across 5 different buildings. And by the end of the year, all points are heading towards a vacancy rate that's going to be below 2%. So once there's a supply shock, there needs to be a trickle-down effect to the other asset class, right? So at the end of the day, throughout the COVID pandemic, we saw a lot of landlords that were holding asset playing catch up with landlords that had already foreseen, the great amenitization need that tenants were looking for. So with landlords now completing their restoration or renovations of their building in 25, 26, 27, those A-class assets will now meet the needs of the tenant of today. A good statistics that I keep seeing is, in Montreal, since 2022, there's been a total of 1.8 million square feet of new AAA inventory that's been introduced to the market, which represents about 27% of our total trophy asset inventory. And they've almost all been leased since then. So, we're talking about flight to quality. We're talking about all these trends, and we haven't had a lot of new development in Montreal. They've almost all been exclusively trophy assets, and the demand is there, and they're getting leased up, and eventually, the demand's going to fly down to the lower class asset. And I hate to say this word because at the end of the day, they still offer the same, service and quality that, the trophy assets could offer.
But it's tough. How can B and C class compete? I mean, these are aging stocks in the market. Are they still going to be relevant at some point? And to Scott's point, you mentioned conversions happening. Would there be even an uptick in conversions, or are we seeing, a heightened modernization of these spaces to meet the demands that tenants have today?
Yeah, I mean, I don't think conversions are ever going to be a material, amount of what's driving increased occupancy. I think it's obviously around the fringes. It's happened in Calgary, it's happened in a few markets, but it's never going to be material. I mentioned it before because it is happening, but that's certainly not what's driving things. But look, I think at the end of the day, it's real estate, right? So landlords have to invest capital in their assets. And so you can have a B or a C asset and still invest the right amount of capital. So it's a good place for people to come and work. And as I mentioned before, you might be competing more on economics there. But at the end of the day, I think the development pipeline and to Thomas's point, supply and demand, that will work itself out. But I think you just need, as you go down the kind of quality spectrum, to me, at least, it becomes more about economics and how aggressive you're willing to be to attract tenants to your buildings. And it becomes very dependent on being specific of what assets you own. So you can own a B asset, but if it's a really, really well located B asset in a great micro market, like, you're going to be fine, right? And I think that's what really separates investors who are being very, very pragmatic about where they own their office, and you can still outperform from a total return perspective owning those types of office assets as long as they're in the right micro markets, right? And as long as you're managing those assets properly, and you'll set yourself up to succeed. I would bring up an example in our portfolio in Toronto. We have an asset downtown Toronto on University Avenue, on the west side of University Avenue. We spent a lot of money building out a spec suite there, but it would actually, Green Street just posted an article about the fact that it's harder. It's not that hard to find a 20 to 30,000 square foot block of space in Toronto right now. But once you start looking for 100,000 or more, your options become few and far between, especially in the trophy space, because the trophy space has been taken up, especially over the last 12 months. And so, the asset we own in University Avenue, which is very much a Class A asset, but certainly not a trophy asset. It's one of the few 150,000 square foot blocks of space that kind of are on the market in the core right now. So, that space, I'm pretty confident is going to lease, and so it just kind of goes to show that the assets, again, kind of down that quality spectrum, and I qualify that to Thomas's point, because I'm still talking about a Class A asset here. But those assets will still win, and I still think it might take a couple of years for your blended occupancy to get back to where it was pre-COVID. Going back to the start of this conversation, but I think it's absolutely going to get there.
Mm. Yeah, and to your point, when it comes to leasing, we kind of already know who's already touring these spaces. We have an idea of which sectors are coming back in, but I guess perhaps what I'd want to know, and Scott, I want to ask this question to you, and then Jennica, if you could maybe chime in as well. What kind of tenants are you seeing in the market looking for these quality spaces that you're referring to? We've seen banking. We've heard government is coming back. Tech, is it coming back too, or what's going on with that?
Tech is coming back slightly, but still not in a meaningful way for Vancouver. But we're starting to see AI groups. We had a couple global AI groups peeking around Vancouver, which is exciting because normally once they kind of set up shop here, then others seem to follow. And then just from looking at tour activities, our tenants in the market list, we're constantly tracking who's active, what the requirement is, what they're looking for. There's a ton of local growing AI startups, and a lot of these are, let's call it 5,000, 4,000 square feet, but then they'll expect to double in the next year and hopefully have, continued growth in that to that level. So I suspect that will increase just as more companies come here. And then Vancouver has always benefited from just the location, tax credits. So a lot of the San Francisco companies typically when they'll expand, of course, there's Toronto and Montreal, but Vancouver's has always kind of taken advantage of the close proximity. It's easy, 1.5 hour flight to and from, same time zone. We've had tons of tax credits for gaming companies and VFX and a bunch of other kind of sectors within tech. And so because of that, I think tech has softened and we're not seeing it in the same way, but it will come back just given those variables and given kind of the small local growth that we're starting to see and where they plan on going. So soften for right now, but think that will grow over time.
And Scott, do you see any new sort of tenants coming in toward these spaces? Any new sectors? Not new sectors, perhaps sectors that we haven't heard of or from, just kind of taking a backseat during the pandemic. Have they sort of reemerged into the market looking for space?
Nothing that Jennica hasn't frankly mentioned, and no kind of sector that I would call out specifically. But what I am seeing are just a lot more large RFPs. Thomas obviously mentioned Michelin in Montreal. That was a great deal. Colliers did a phenomenal job. But we're just seeing a lot more large RFPs in the market looking for large blocks of space because, again, as I mentioned before, these companies have finally made the decision on what the future is going to look like, and they're ready to commit. Which is great to see, and we're frankly seeing that in every major market across the country.
Mm. And then Thomas, in the last few years, we've looked at data, and because you're sort of focused or landlord focused as well, what are you noticing that's happening differently in terms of tour behavior and lease commitments? Are we seeing stronger covenants coming back into the market? What's that look like now that we've entered into this point of, supposed optimism? I don't want to say supposed optimism. I say it is happening. We are seeing healthier fundamentals. How's that changed the behavior of tenants who are touring and then those commitments that are being made?
I think you touched it on your last point. I would say that it's mostly commitment from the tenant. We have to remind ourselves that Quebec was hit completely different than the other markets when it came to, the COVID era. Essentially, Quebec had 2 6 months curfew. So when we're talking about return to office policy, it's completely different from Vancouver or the States or even Toronto, because we simply could not go anywhere else but home for a very long period of time. So, we as a province were stuck home for almost 18 months. So, having the companies and the employers try to drive their needs forward when it came to the real estate needs was very difficult because everything was uncertain. And coming back to my point earlier, where the labor market had the bigger end of the stick, it made it even more difficult for tenants to really fully understand what their future needs were going to be. So before, over the past couple of years, we had, the length that it took to close the deals could be very long, obviously very variant compared to how, depending on the industry and how committed the companies were willing to move forward with their lease transactions. But that's what we're seeing right now. The deals are moving a little faster. There's more commitment. It's essentially what's driving that is their better understanding what their future office needs are going to be. So, that's coming from employers and companies being able to have firmer commitments on the return to office policies. So whether it's 2, 3, or 4 days, then that answers their questions about what their needs are going to be for the short and medium term, at least, right?
Mhm. Right. I think we have time for one more question, and this one I want to throw over to Scott. Uh, what kind of properties do you think we're going to be seeing exchange hands in 2026? I mean, what kind of activity are we going to be seeing in terms of appetite for office if we are, in fact, coming back to a more optimistic view of office? What kind of product is going to be shifting through the market?
Well, obviously, there's conversations about office, so I'm going to stick to office. So, look, we're seeing we're seeing a lot of trades happening in the market now. There was one just announced today, the day that we're recording this, where the government of Canada just purchased a building downtown Ottawa, for their workforce coming back, 4 or 5 days a week. So that's great to see. But you look across the market. Obviously, the Lake Tower in Montreal is just traded to, to DECA. You're seeing assets in Vancouver trading. Generally speaking, these are assets that are trophy assets that have long-term walls. People can underwrite them, and yes, they're trading at cap rates that are relatively high from a historical perspective, but at least we're starting to see trades in the market. I think going forward in 2026, based on all the conversations I've been having, and I'm sure Thomas and Jennica, you haven't seen conversations. I think there's a lot of people on the sidelines that are salivating right now because we're going to have a couple great vintage years of people able to get into not just trophy, but able to get into, the A's and the B's and the C's at phenomenal basis. That is below replacement costs. And yeah, they're going to have to go spend some money, but they're going to get an attractive basis and make some fantastic returns. So, I think we all know the usual players that are probably, out there raising capital as we speak and getting ready to deploy that capital across the country. But yeah, I think there's a lot of people that are really excited, and I actually think for those platforms that are out chasing yields right now, in order to perform, I think the office is like the one asset class that if you buy it right, per my point earlier, in terms of really being focused on the right locations and the right product, there's a lot of money to be made in the office sector right now. So I think you're going to see a lot of trades there.
Great. Definitely glad to hear that we're returning to some sense of normalcy after the last 5 or 6 years of nothing but pure chaos and disruption. But you know what? I'd like to thank our guests for joining us on this edition of Colliers Talks. Great show, a lot of information being thrown around. And I hope you, the audience, have had a chance to listen to the insights, get a little bit from each of our guests, and take away some very important points that perhaps could help you in your decision-making process moving forward. So again, we'd like to thank you here at Colliers Talks, and we'll see you for our next one. Take care.
Thanks,
Thank you,
everyone.
Eli.
Thank you, guys.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.